Welcome back to Investing Talk podcast.
Glad to be here.
We're taking your research, all those articles, notes, the raw data, and boiling it down into the insights you really need. Trying to give you that shortcut to being genuinely well-informed. And today, we're digging into a question a lot of you are asking. Is Ormat Technologies a good time to buy right now?
It's a really interesting one, actually. Ormat sits right at that crossroads of renewable energy and energy storage. And, well, both sectors are seeing just massive shifts.
Yeah.
So our goal today, really, is to cut through the hype. Look at the actual numbers, the financials, the growth, the risks, based on all the analysis you've provided. Give you the full picture.
Absolutely. And there's a lot to unpack, isn't there? We've got everything from explosive growth in some areas to, well, some pretty serious debt we need to talk about. Before we jump right in, though, if you are finding these deep dives helpful, please do hit that subscribe button, maybe give us a like or leave a comment. And if you're feeling particularly generous, you could even buy us a coffee. It genuinely helps us keep doing this.
It really does.
Okay, right. Ormat Technologies, geothermal energy, energy storage, related products. You know the basics. Our mission here, what does the data really tell us? Is it a buy now?
Let's find out.
So let's kick off with the fundamentals. The sources you sent over, they highlight some really interesting stuff happening with their revenue. What's standing out to you? How are they growing?
What's really striking is the diversification story, I suppose, and how different the growth looks across their three main parts: electricity, energy storage, and products.
Right.
So Q1 2025 overall revenue was up, but only slightly, like 2.5% year over year, to about $230 million.
Okay. Modest.
Yeah, but then you look at energy storage.
Yeah.
And it just exploded. I mean, it surged almost 120%. Yeah, 119.7% up to nearly 18 million. And the product segment did well too, up almost 28%. So it's really a tale of two or maybe three cities.
Okay, 120% in storage. That's definitely eye-catching. But the flip side, I guess, is their core business, electricity. That actually went down, didn't it?
It did, yeah. That's their biggest piece, about 180 million in Q1, and it saw a drop of nearly 6%, 5.8% decline.
Why was that?
It seems it was mostly down to specific operational things, grid curtailments, problems in California and Nevada, and unfortunately wildfire impacts too.
Right, the wildfires. That seems ironic for a green energy company.
It does, isn't it?
Yeah.
But it highlights the real-world challenges. Still, it's important as the bigger trend. Full year 2024 revenue was $880 million, up 6% from 2023.
Yeah.
And management's guiding for $935 to $975 million for 2025. So despite that Q1 dip in electricity, the overall picture is still pointing towards growth.
Got it. So the growth is really coming from those newer, higher growth areas like storage and products. How about profitability there? Margins, are they strong everywhere, or is it a similar story?
Not strong everywhere, no, and that's really crucial for investors to understand. The overall group gross margin dipped a bit in Q1, down to 31.7%.
Okay.
And that was mainly because the electricity segment's margin got squeezed quite a bit, down 550 basis points. That's 5.5 percentage points, down to 33.5%.
Ouch.
Yeah, but here's the interesting part. That drop was significantly offset, mitigated, by the storage segment. Its margin jumped massively.
From that big revenue growth.
Exactly. It went from just 7.5% in 2024 up to over 30%, 30.6%. And products margin improved too, up to 22.3%.
Why the big jump in storage margins?
Seems to be better pricing, particularly in the PJM markets, those big East Coast electricity markets. Plus, they have a really strong product backlog, about $314 million, with projects in places like New Zealand and Dominica.
So this shift towards storage and products isn't just boosting the top line, it's actually helping the overall profit picture, even with the core business facing headwinds. That's quite a key point. What's this mean for their long-term plan?
Well, it definitely feeds into their strategy. They're targeting pretty ambitious growth, like a 16% compound annual growth rate through 2028.
Wow, that's high.
It is. They're aiming for about 2.6 to 2.8 gigawatts of capacity. And they plan to get there through, building their own stuff, but also buying other companies.
Any examples?
Yeah, the big new term one is the Blue Mountain plant acquisition. It's about $88 million, should close pretty soon in Q2. So it shows they're serious about expansion.
Okay, so aggressive growth, strategic shifts, but growth costs money. How are they funding all this? Let's talk about the balance sheet. Is it strong enough?
Right, and this is where, honestly, we hit a major point of concern. The data shows Ormat is carrying a lot of debt. Highly leveraged.
That's high.
Their debt-to-equity ratio hit almost 99%, 98.8% in 2025. That's up from about 91% 5 years ago. So they basically borrowed almost as much money as the entire value of the company owned by shareholders.
Yikes.
Total debt is about $2.56 billion against equity of $2.6 billion. And what's maybe more worrying is how well they can cover the interest payments.
Right.
Their interest coverage is really thin, only 1.3 times earnings before interest and taxes, and their operating cash flow. It only covers about 15% of their total debt. It's not a lot of cushion.
Wow. Okay. That is a lot of debt and very thin coverage. So is this aggressive financing, it definitely carries risks, doesn't it? Especially if things don't go perfectly.
Absolutely. I mean, it's enabling that 2.8 gigawatt target, sure, but it makes them much more vulnerable. If interest rates go up, their costs soar. If there are construction delays on these big projects, that puts pressure on too. They took on over $500 million, $558 million, in new long-term debt just in 2024, mainly for these expansions. They have some cash, about $113 million, which sounds okay. But their short-term assets don't quite cover their short-term liabilities. And they certainly don't cover that huge pile of long-term debt. So execution risk is definitely elevated here.
Okay. Growth potential, check. Significant debt risk, double check. That brings us straight to valuation. How's the market pricing this? Is it seen as a sure thing, or is there caution baked in?
Well, based on the numbers, Ormat is definitely trading at a, shall we say, significant premium compared to others in the utility sector.
How significant?
Its trailing price-to-earnings ratio is over 38. Forward PE is around 37. The median for the utilities industry, more like 15.
Wow, more than double.
Yeah, and price to sales is also way higher, about 5.4 versus an average of 2.4 for competitors, so nearly 100% higher there, too.
Yeah.
You're paying up for this stock.
That is a hefty premium, especially like you said, when Q1 revenue growth overall was only 2.5%. What could possibly justify that kind of valuation? Is there anything?
Well, that's the million-dollar question, isn't it? I mean, part of the argument is their unique spot in geothermal. It's baseload renewable power, runs over 90% of the time, very reliable, unlike solar or wind.
It's true. Consistent power.
Exactly. And that explosive growth and margin improvement in energy storage, that also supports a higher multiple than your standard, maybe slower-growing utility.
Okay.
But, and it's a big but, their 5-year average revenue growth is only 3%. That doesn't really scream premium valuation.
Yeah.
And their return on invested capital, it's actually been lower than their cost of capital for 7 of the last 10 years.
So the market is pricing in a lot of future success that hasn't consistently shown up in past financial returns.
Precisely. There's a gap there between historical performance and current expectations baked into the price.
Okay, so a bit mixed on valuation. What about the technicals? For people watching the charts day to day, what's the stock doing? Strength or weakness?
Technically, the picture looks pretty constructive, actually. The stock's currently trading above its key moving averages, the 20-day, 50-day, and 200-day.
Which usually means?
It generally confirms an uptrend across different time frames. The RSI, the Relative Strength Index, is around 62. That's sort of neutral, not overbought, which is good. And the MCD indicator is signaling bullish momentum.
Okay, so the trend is up. Momentum looks positive from a technical standpoint.
Correct. For traders, that's often seen as positive. For long-term folks, it just confirms the recent upward move, but again, doesn't change those fundamentals we talked about.
Understood. And are there specific price levels that people should be watching? Support and resistance?
Yeah. Looking at the chart, critical support seems to cluster around $73.23. That was a low back in June. And maybe $71.50, which was a swing point in March.
And on the upside?
Resistance looks like it might come in near $86. That's actually Barclays' recent price target. After that, you're looking at the psychological $90 level. And if it breaks $86 convincingly, you could argue it might target the all-time high, which is up around $94.24.
Okay, useful levels. Now, let's zoom in on recent news and just the general buzz or sentiment. What's been driving the stock lately?
Well, a big factor recently is the accelerating demand for energy from data centers. It's a huge theme.
Right, AI and all that.
Exactly. Barclays pointed this out in their upgrade in June. They went to overweight with that $86 target. They highlighted geothermal's appeal because it's 247 clean power, just what these power-hungry data centers need, especially with worries about grid shortages.
Makes sense. Anything else?
Yeah. Ormat also recently signed a couple of decent deals, a 10-year power agreement with Calpine for 15 megawatts, and 2 significant storage deals in Israel. Plus, their Q1 earnings did beat expectations. So some positive momentum there.
Okay, so strong tailwinds from data centers, good Q1 beats, some new deals.
Mm-hmm.
Any red flags or negative signals popping up that investors should be aware of, besides the big debt, of course?
Well, debt is the main one. But
Ah.
beyond that, yeah, a few things. There's been some insider selling.
Mm.
A director, Byron Wong, sold about 460 shares recently
Is that significant?
on its own, maybe not hugely.
Mhm.
But it continues a pattern over the last year of insiders selling, but not buying. It's just something to note.
Mm.
Also, those operational issues we mentioned, the electricity segment downtime in Q1, the ongoing wildfire risk, those vulnerabilities haven't gone away. And that high valuation, that PE premium of 150% over utilities, it just leaves very little room for error. They really need to execute flawlessly.
And sentiment. What's the chatter like?
Social media seems kind of neutral, actually. People acknowledge the potential in storage, definitely. But they're also highlighting those debt concerns we've discussed. So a balanced view, perhaps.
Okay, so we've looked back, looked at the present. What about the immediate future? Any catalysts coming up soon? Or major risks to watch out for?
Sure. Immediate catalysts. Well, the closing of that Blue Mountain acquisition should happen this quarter, Q2. That adds 20 megawatts of geothermal capacity.
Okay.
And then the big one is the Q2 earnings report, which is expected around August 5th. That'll be crucial. People will be watching storage growth, obviously, and any updates on that PJM pricing.
And longer term?
Longer term, it's really about those data center deals. Ormat is negotiating power purchase agreements, PPAs with the big hyperscalers.
Yeah. Like Google, Amazon.
Exactly. And reportedly, they're negotiating prices often above $100 per megawatt hour, which is quite strong. Also, looking out to 2028, a lot of their older legacy PPAs are due for repricing, which could potentially lift their electricity segment revenue quite a bit.
Okay, sounds promising on the catalyst front, especially long term. But let's be clear about the risks. What absolutely must investors keep an eye on?
Right, the risk assessment. You've got company-specific risks. Number one is that high leverage, then the volatility in the electricity segment from things like grid issues or wildfires, and just pure execution risk. Can they actually hit that big 2.8 gigawatt target without stumbling?
Okay, company risks. What about broader risks?
Sector-wise, you worry about regulatory changes. Tax credits could change, permitting could get harder. And in storage, those good margins they're seeing now in PJM, market conditions could shift, compressing those margins.
Makes sense. And macro.
The big ones are interest rates. Higher rates make that debt burden even heavier. And of course, a recession could hit electricity demand. Finally, that negative free cash flow yield, negative 4.09%. It basically screams overvaluation if growth slows down even a little. And as mentioned, the August earnings report is a definite event risk.
Okay, that's a very clear picture of the risk. So let's bring it all together. Based on everything we've unpacked from your research, is Ormat Technologies a good time to buy now? What's the verdict?
Okay, so boiling it down. For long-term investors, we're giving it a 6.5 out of 10 rating. For short-term traders, maybe a 5 out of 10.
Explain that difference.
Well, look, the company's geothermal know-how is solid. That storage growth, 120% year over year, is genuinely impressive. And the data center tailwind is real and significant. It makes for a compelling renewable energy story.
What?
But that extreme leverage and the sky-high valuation just demand caution. You can't ignore those factors. Hence the sort of lukewarm rating, especially for shorter-term plays.
Okay, so for the long-term investor, the 6.5 out of 10, if they do want to get in, what's the smart way to do it? Is there an ideal entry point?
Based on the analysis, yeah, we think an optimal entry range would be somewhere between $75 and $79 per share.
Why that range?
It represents a decent discount, maybe 6–10% from where it is now. It lines up with those technical support levels we talked about.
Yeah.
And it gets closer to or below what some might see as its intrinsic value. Also, crucially, because of the risks, keep the position size manageable, probably no more than 2.5% of a diversified portfolio.
Right, risk management. And what about those short-term traders, the 5 out of 10 rating? Any advice there?
If you're trading it short-term, maybe trying to play the earnings catalyst, you absolutely need strict discipline. We'd suggest a stop loss maybe around $72.90, just under that June low. Protect your downside.
And profit targets.
Conservative target might be that 86.10 level. More aggressive could be $92, closer to the highs. And just remember, the dividend is tiny, only 0.58%. This is a capital appreciation play, not an income one.
Okay, so summing it up, a buy for long-term investors, but be patient, aim for that $75, $79 entry range, and keep the position small.
Exactly. It's a BUY for the long term in that specific range if you believe in those renewable megatrends. For trading, just be extremely careful, use stops. And for everyone, Keep a close eye on those debt levels and definitely watch that Q2 earnings report. It needs to validate the growth story.
That was incredibly thorough, a fantastic deep dive into Ormat technologies. Really shows how you need to look beyond the headlines, understand the different parts of the business, the risks, the valuation.
Indeed. It's never just one number.
Yeah.
True understanding comes from seeing the connections, knowing why things matter, and always asking, okay, what does this imply for the future? What are the next questions?
So what stands out to you from this deep dive? What new questions does it raise for your own thinking? We really encourage you to keep digging, keep learning, keep asking those big questions. Thanks so much for joining us.
Thanks for listening.
We'll be back soon with another deep dive.